Hello and welcome. In this video, we will learn how the futures are priced and also how margin is calculated. Okay. Now, this video is just to gain some knowledge about the pricing of futures and margin. Alright. So you don't have to worry about all these things because these are done automatically. Alright. So let us proceed. First, before we learn how the future price is calculated, we need to know what spot price is. Okay. Now, this is the definition of spot price. Spot price or spot rate is the current value of an underlying asset for which it can be bought or sold with the expectation of immediate delivery. Alright. So, in simple words, let me explain it to you. Now, this is a screenshot or these are screenshots which are merged together to show you the spot prices at various times. Okay. So, Cipla is a company and its spot price at 12:30 p.m. on 12th April 2023 was this much. 915.90 rupees. It means that if you wanted to buy one stock of Cipla at 12:30 p.m. on 12th April 2023, then you should have been paying this much money. Okay, 915.90 rupees. And you know that the price of a stock keeps on fluctuating. It goes up, it goes down. Correct? So soon after this, at 12:32 p.m. on the very same day, the price of Cipla stock was this much. So you can see that it has increased from 915.90 to 916 rupees. That means if you wanted to buy one Cipla stock at 12:32 p.m. on 12th April 2023, then you should have been paying 916 rupees. Same way at 12:35 on the very same day, this was the amount at which Cipla was being traded. Alright. So these are spot prices of these types, or I can say spot price is the current market price at which you can buy a stock or underlying asset immediately. Okay. So at 9:30 it will be one price, at 10:30 it will be one price, at 12:30 one more spot price, at 1 p.m. one more spot price, and so on. From the time the market opens till the market closes, the price keeps on fluctuating and also the spot price. Alright. So spot price is the price, market price at which you can buy the stocks immediately. Alright. Now, here is the same screenshot from the previous slide, and this is the screenshot from this time. Okay, 12:30 p.m. on 12th April 2023. Now, these are the prices of futures. So, you can see Cipla April future, Cipla May future, Cipla June futures. Okay. Now, I told you that this is the price of futures at 12:30 p.m. on this date. You can see that there is a variation here. This is 915.90 and this is 920.40. There is a difference of 5 rupees. Why is that? This is because the future price is calculated using a formula. Well, once again, you don't have to remember this. You should not remember it actually. You do not have to worry about it because this is done automatically by the exchange. Alright. So this is just for your information. Now the futures price, this price is calculated using this formula. Spot price, which is this price. Okay. Spot price into this, finally minus this. Okay. What this gives you is the time value of money. The concept behind this is that this is the minimum return earned if the investment was made on a future date or on the futures date. Okay. So basically this is the opportunity cost of investing in security in the present versus in the future. Now this may sound very confusing to you, so let us drop here itself. Do not worry much about this. Okay. So the X here is the number of days till expiry of the future. Alright. And then minus dividend. So D is dividend. I had told you in the previous video that the dividend is included in the futures price, correct? So here minus D. Let us say that the company Cipla announces dividend in the month of April. Okay, April. So if the company announces dividend, then it will be available for stockholders or those who buy the stocks, correct? So it will be included in the price. But this dividend is not available to those who trade futures, correct? And so that is deducted here. Okay, that is deducted here only when a dividend is made available to stockholders. In other months, the D value will be 0. Okay, the D value will be 0. Alright. So this is how they calculate futures price, and this is why this price will be higher than this. Okay. Once again, this is just for your information. It is not required to remember this. Proceeding further, the margin money that one has to pay while buying or selling futures is calculated like this. Okay. So this total margin is what you need to pay to the broker. Now total margin is equal to span margin plus exposure margin. Now what are these? Span stands for Standard Portfolio Analysis of Risk. So this is a method of calculating risk, and this name is derived from the software which calculates that too. Okay. So span. Now this is done by exchange. This value, this span margin value is calculated by exchange, and this is kept by the or blocked by the requirement of exchange. Okay. So how do they calculate it? Now they calculate it on various factors, the majority being the maximum risk that the underlying asset has on that particular day. Or in other words, I had given you the example of Cipla, correct? On that particular day, the maximum movement that the Cipla stock can have. What is the worst possible movement? So let us say that the market crashed or some bad news came, due to which the price went in an unpredictable way. So it has a risk, correct? So buyer or seller will be at risk. So this is taken into account while calculating span margin. Alright. Now this span margin is calculated daily, all right, because daily the condition of the market changes, the risk involved on that particular day changes, the next day changes, the next day changes. So this margin is calculated daily, and so the total margin requirement changes daily. Okay, then the exposure margin is the amount that is held by the broker. Okay, so just to keep him safe, because of the fluctuation of the price. So let us take an example. If the total margin is 10,000 rupees, then it is made from two components. One is span margin and one is exposure margin. So span margin is the requirement of exchange. The exposure margin is the requirement of broker. Now let us say that on any particular date, the price moves violently and the loss is 8,000 rupees. Okay, so it doesn't matter who the loss is to, the buyer or the seller. The loss for anyone is 8,000 rupees. 7,000 rupees is in the span margin. 7,000 rupees is in the span margin. So the exchange is fine now, but it needs one more or 1,000 more, because the loss is 8,000, correct? So the exchange will ask the broker, so give me the extra 1,000 rupees. So from where will they give? From the exposure margin. Okay, from the exposure margin. So this is to safeguard themselves. The brokers take this to safeguard themselves against the fluctuation of the price. Okay, but just know that it is made from two components, and this is what you need to pay while buying or selling a future. All right, and once again, as I mentioned, this is calculated automatically by the software or the broker that you are using, and you do not have to worry about any of this. So this was just for your information. All right, so I'll see you in the next video. Till then, take care and thank you for watching.